Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday's Mortgage Minute. Welcome back to a new week, and boy, is this going to be a week for the record books. You might be thinking, I feel like you said that back in June. I did. Yeah, I did, because back in June that was true. It is also true this week, and let's get right into it. For several weeks, I've been telling you that at the end of July, we're going to get the Fed's rate decision, and then we're also going to get their sentiment about how the health of the economy is looking. Here's a quick rundown of all the economic data coming out this week that's going to cause volatility in the mortgage rate market. On Tuesday, you have the consumer confidence number coming out and the new home sales number. Wednesday is the biggie. We have the pending home sales number coming out, but that is going to be easily overshadowed by the Federal Reserve's rate decision as well as their press conference. Once again, we're in this Ross and Rachel, will they, won't they? Are they going to do 75 basis points as announced? Are they going to do a 100 basis point rate hike because that might be what is necessary to slow down inflation? If you recall, the last several weeks we've been talking about how consumer inflation is hotter than they expect, wholesale inflation is hotter than they expect, and that right now there's no indication that what they've done up to this point has actually made its impact and gotten through the economy. There's people on both sides of the argument. A lot of people are just saying, yeah, it's going to be 75 basis points and that's it. 100 points might be too much of a shock. We'll see if that happens or not on Wednesday. But what that really means is that we're going to get the Fed's sentiment about what they see in the economy and what they think they need to do to continue tamping down inflation. And remember, they've already told us they're going to do whatever it takes, which kind of means any other part that needs to get run over along the way in order to achieve the goal of minimizing and then reducing inflation is kind of just going to be victim to those choices. So let's not be surprised when we see a lot of other things happening and having fallout and having trouble in their part of the economy at the mercy of the decision to raise rates and bring down inflation. Thursday, things get really interesting, and this is because the GDP number comes out. The traditional definition of a recession is 2 consecutive quarters of negative GDP. Now that could be negative 0.1%, that's still negative. It could be negative 0.5% or negative 2%. That's all. Negative is negative. 2 consecutive quarters of negative GDP equals recession, and we believe this for decades. Except for now. For some reason, we have a lot of people front-running this reading that's coming out Thursday, telling us in headlines, you have pundits saying this, and even Janet Yellen saying that we actually may not be in a recession. It may be a technical recession by the historic definition of a recession, but why would we be changing the definition now? Even last week, you have the White House coming out with a new definition of what a recession might mean, which is throwing in a lot of other stats that traditionally have not been part of that definition. So we have to ask ourselves, who's going to be right in this? They both can't be right. You can't have pundits and Janet Yellen and the White House saying one thing and our traditional definition saying the other, when I think what's really happening is they're trying to front run this because they already know that the GDP number is going to come out negative, and it's going to prove right all the people who have been saying in advance of this that we are in for a recession. Now, that does not mean that the sky's falling. That does not mean that everything just vanishes and goes off into thin air. It just means that it doesn't look good in the economy, and it means that the continued pain that has to happen will continue to happen in order to correct the missteps that were not taken 6 months, 12 months, maybe even 18 and 24 months ago when the pandemic first started. Final note on GDP. If they didn't think it was going to be negative for quarter 2 of 2022, then the headlines would be different. Janet Yellen would be saying something different. The White House would be saying something different. And the bankers would even be saying something different. All these CEOs that have been going on talk shows and giving interviews and going on podcasts, they are saying starkly different things than the other people that are on TV. So both of them can't be right. One of them will be right. And I think that if a positive GDP reading were to be expected and was already known, then we'd already be hearing about it. But we aren't. And that's going to lead us into Friday when we have the PCE number, which is another consumer inflation reading, and I'm not sure how that's going to look. And we have a bunch of other additional consumer readings that are going to tell us how is money being spent through the economy at large. And I think that's going to cap off a very interesting week of economic data, and we're going to see how the chips fall. Now, for mortgage rates, I think given what I've told you today, it is expected that they're going to be really volatile. I do not agree that everything is already priced into the market. I don't think that everything's priced in with commodities and the price of metals. I don't think things are priced in indexes, and I certainly don't think things are priced in with the bond market yet. I think that what's going to come out this week is going to provide confirmation of what the marketplace believes has happened and is going to continue happening until they get a course correction in the numbers and the data. I think there is continued pressure in all of the markets until you actually see the inflation number flatten and decline. Until that point, the Fed's admission that they're going to continue doing rate hikes and put monetary policy pressure on inflation, everything else is going to be at the mercy of that. So those of you that are hoping to lock your loan this week, you have to stay very, very close to your loan officer. Yes, I know I say this to you all the time, but this week is critical. This week has a lot of heavyweights in the economic data, and it is going to determine the price direction for the bond market for at least the next 3 months, maybe even the remainder of 2022. So if you already have an escrow open and you need to lock your loan, make sure you're in very close contact with your loan officer to determine the day where the price volatility is in your favor. And if you happen to miss the conversation that Memo and I had last week about making the case for a cash out refinance, be sure to click on this video right here and go back and watch that after you finish watching this. We covered a lot of different ways that people are tackling debt right now in the marketplace, using the equity that they have in order to put it to work and help fuel some other financial initiatives they have by curing debt, paying off a lot of deadweight in debt, and then also saving up some money for a rainy day, all while leaving plenty of equity in your home still. As always, be sure to like this video, share this video with people you know, love, and trust. Let us know how we can help you win in mortgage and real estate in 2022. Thank you so much for watching, and we'll see you again next week.